Hello and welcome everyone to Almus Market Mornings, your daily dose of financial updates. This is your host Swaraj and I'm filling in for Shikhar Garg. Now, we have had some quite developments overnight, especially with US Fed Chairman Jay Powell putting a half-point rate hike for May on the cards. The US 5-year and 30-year yield spread was narrowest since 2007. Now, JK, we have started seeing more hawkish tone from Fed. What's your take on this and how have markets reacted overnight?
Hey, good morning, all. So I think we don't have any day without a new development or new statement that moves the market. And yesterday it was all about Powell. His speech at the National Association of Business Economics annual economic policy conference was one of continued hawkishness, hinting at the central bank's readiness to hike at a faster pace if situation demanded. He delivered his most muscular message, I would say, to date on the battle with high inflation, saying central bank must move expeditiously to raise rates and possibly more aggressively to keep an upward price spiral from getting entrenched. He has signaled actually an urgency on the central bank's part to the inflation challenge that was visible just a week ago when he delivered his first rate hike in 3 years. In particular, he has added that if we conclude that it is appropriate to move more aggressively by raising the Fed funds rate by more than 25 basis points at a meeting or at meetings, we will do so. So we might as well have 50 basis points at more than one meeting. This is what he's saying. Markets took those statements like very hawkish and reacted. Stocks fell, bonds fell, yields rose. So adding to this was even one of the Bundesbank members, Mr. Nagel, who said the European monetary policy cannot sway from the current inflation drivers and shouldn't delay exit from the very loose monetary policy, and risk of acting too late on inflation has risen. So they're actually hinting at the bond purchases from Europe being, cut much earlier. So we really need to wait this. Then adding weight to all these things was the Fitch ratings, which cut the outlook for GDP growth for the world by zero point 0.7 percentage point in 2022, and made sharp upward revisions to the inflation forecast. So they said that the global inflation is back with a vengeance after an absence of last 2 decades. And this is starting to feel like an inflation regime change. So it's something really we need to take note of. And all these things together, put the risk off in the front of the market. And of course, on the war front, we had a statement from Turkish Foreign Minister who expressed optimism about the progress of negotiations between Russia and Ukraine. In an interview, he had said there was convergence on the two countries' position on critical issues. In fact, Zelensky had called for direct talks with Putin, who had continued to receive phone calls from world leaders. Kremlin spokesman ruled out a meeting between the two presidents unless there was a prior agreement on all issues. So basically, they want to prepare a ground for a comprehensive agreement before they can meet. I think the contentious issue is Crimea and Donbas region, which Russia wants Ukraine to recognize as independent. And once that issue is agreed upon, or some sort of reconciliation is seen, that is when we expect this peace process to start. But amidst all these, oil prices have again gone up. Brent almost touching 120 once again from a low of 95 seen last week. An attack by the Iran-backed rebels in Yemen struck half of the dozen sites in Saudi Arabia, driving oil prices higher initially. Also adding to the pressure on oil prices was news that Europe is also considering an embargo on Russian oil. So a combination of various factors leading to negative risk sentiment in the markets. That is how we say. Dollar obviously once again in demand, particularly against the euro, which seems the most affected. Of course, yen has been on a weakening trend against the dollar. although we have hit a level where it can become a bone of contention. Like 120 is a level where at least some in the market seem to think there can be an official resistance uh, from not only Japan, but even from the Fed, who may think that the currency is being allowed to weaken too much, and that may be in the bone of contention in the coming days. So we might even see some intervention, is what people are thinking. So we are definitely into a sensitive area as far as Delhi is concerned. Overall, dollar is strong, but commodity currencies are also strong because the rise in commodity prices. So all these things don't bode well for INR, which anyway started with a gap up yesterday and never, went lower after that. And steady demand from oil companies was seen throughout the day, pushing the USD INR to close to 76.20 yesterday. Today it looks like we'll see another 20 paise up move. But above 76.30 is something interesting to look at, because that is where some technical chart points lie, and also possibly RBI will come back into play. RBI's actions will come back into play. They might start offering the dollar if it starts to move beyond 76.40 levels. So a weakening start for the rupee, but it might be contained by RBI actions. Definitely more sustainable recovery in the rupee is only possible if oil again starts to come down. Until then, rupee will be under pressure. Yeah, have a good day. Thank you.
That was wonderful. So, guys, to sum up, US Fed, not just the US Fed, the world is battling with some inflationary pressures. We have started seeing the US Fed become more hawkish. And as JK said, we have seen stocks fall, bonds fall, and yields rise. We are also seeing an increase in oil prices, which is now trading at about $120 a barrel. So, guys, follow your risk management practices in these uncertain times. That's it for today. Take care and see you tomorrow.